For nearly 2 decades, Wall Street has lived by the gospel of forward guidance. It was the ultimate safety net, a promise, a nudge, a whisper from the Federal Reserve that allowed investors to gaze into the future of monetary policy. We were conditioned to look for the dots, the subtle shifts in language, and the steady, predictable drumbeat of central bank transparency. But that era is over. The Federal Reserve has officially ended forward guidance, leaving Wall Street to trade without its traditional policy signals. Under the leadership of Chair Kevin Warsh, the Fed has undergone a profound transformation. In his debut policy statement this June, Warsh delivered a document just 131 words long, the shortest non-emergency statement on record. There was no easing bias, no hint of future cuts, and no comfort for those seeking a roadmap. As Warsh himself put it, forward guidance has become a shackle around the central bank's neck. He argues that promises about the future only serve to erode credibility when the economic ground shifts beneath our feet. Think back to the atmosphere in financial districts from New York to San Francisco. Traders were accustomed to the heads up. If a hike was coming, the Fed would telegraph it months in advance, smoothing out the turbulence. This was the Powell-era consensus: suppress uncertainty at all costs. But for the new chair, the objective has inverted. Warsh believes that by trying to manage the future, the Fed was inadvertently manufacturing bubbles and preventing the market from discovering its own prices. By going silent, he is forcing investors to stop listening to speeches and start looking at the raw, unfiltered data. This isn't just a policy tweak, it is a sea change. When the Fed speaks, it now speaks only of the here and now. The rest, that is for the market to calculate. Without the safety net of forward guidance, volatility has moved back to the center of the trading floor. Now, every release of the Consumer Price Index, CPI, or the non-farm payroll report acts as a potential flashpoint. Look at the current landscape. We are seeing a fascinating and somewhat dangerous divergence. In states like Texas and Florida, where service sector growth has been historically resilient, labor demand remains steady. However, when we look at national real wage growth, the paychecks of the average American, we see a troubling decline as inflation persistently eats away at purchasing power. Meanwhile, energy costs, along the wild card in our inflation calculations, remain erratic. In regions like the Midwest, manufacturing output is feeling the cooling effect of higher interest rates, yet core inflation remains stubbornly sticky. The Fed is not just looking at the national average, they are watching the pass-through of energy prices into core PCE. If energy costs rise, it hits the transportation hubs of Ohio and Michigan harder than the coastal tech corridors. This is the new normal for the Fed, a granular, state-by-state, sector-by-sector analysis that ignores the noise and focuses purely on the math. How do you adapt? The investors who are thriving in this environment are those who have abandoned the Fed-watching hobby. You can no longer rely on deciphering the tone of a spokesperson. Instead, the focus has shifted to leading indicators, watching regional manufacturing surveys from the Philadelphia Fed or the Kansas City Fed before the national numbers drop. Credit spreads, understanding that as the Fed goes silent, corporate risk premiums are the real heartbeat of the economy, the reaction function. Instead of asking, what will the Fed do next? Start asking, what does this data point imply for the Fed's dual mandate of price stability and maximum employment? The economy is no longer being guided by a steering wheel in the hands of a central banker. It is being driven by the combined weight of millions of decisions made by businesses and households from California to New York. Chair Warsh's move is a gamble on the efficiency of the market. He is betting that if the Fed stops talking, the markets will stop guessing and start listening to the economy. For the individual investor, this means the end of the easy ride. The volatility we see today in the treasury markets isn't a bug. It's the feature of a system that is finally being forced to price risk without an artificial anchor. As we move through the second half of 2026, the question is no longer, what will the Fed say? The question is, can you read the data before the rest of the world does?